Hello everyone, welcome back to my YouTube channel. This is Maunashri. I am currently pursuing my MBA in Sri Venkateshwara College of Engineering, Bengaluru, affiliated to VTU, Belgavi. So, in this video, we will be talking about accounting for managers, and our topic is IFRS. So, IFRS stands for International Financial Reporting Standards, and these standards are a set of accounting rules for the financial statements. So, we prepare financial statements in every company. So, these are the rules which are to be followed by the public companies during the preparation of the financial statements, and it is compulsory. And these financial reporting standards are issued by international accounting standard boards, and these are compulsory, and every public company has to follow these and has to adopt them. And we have various lists of IFRS, from IFRS 1 2 3 4 till 17, and we will be discussing about them in detail now. So the first one, IFRS 1, is first time adoption of international financial reporting standards. It means that when an entity is adopting IFRS, it has to undergo certain regulations and the set of rules it has to follow before adopting it, the IFRS. And what and all the lists of IFRS standards have been declared by the IASB, these have to be uh, taken over, and these have to be followed when you are adopting first time for your company when you are starting the business. And the second one is share based payment. This means that all the transactions which are being done in the company has to be recorded, even if the transactions are done with the employees or any other parties or any other, for any other things. These transactions must have a evidence for like cash. When they are dealing with the cash or credit, they have to get the cash memo or the credit bill, and they have to produce as an evidence, and each and every transaction must be recorded without any negligence. The third IFRS is business combination. It means that when a company is taken over by other company, like say when it is acquisition or merger is taking place, that time all the assets of one company and liabilities, and all the assets and liabilities of other company are going to be merged together, and they are going to form a new balance sheet. During such time, all the fair values or the market value of the present goods and liabilities and the assets are to be considered, rather than the any other values, rather than the historical value of the goods. So these the present fair values of both the companies assets and liabilities have to be combined, and the new financial statements must be produced. IFRS 4 is insurance contract. So these insurance contracts are nothing but we get life insurance for our vehicles, or for our life, and general insurance for our various vehicles or things or anything we have. So similarly, the business also must get insurance for all its contracts. And that means it has to reinsure its contracts with it. The fifth one is non-current assets held for sale and discontinued operations. It means that when an asset is being sold, that as particular asset is not depreciated. The depreciation value is not taken, but the value which is fair value or the carrying amount, whichever value is higher in these two, that is carrying amount or fair value, the amount whichever is higher will be considering for the sale value. And the sixth one is exploration for an evaluation of mineral resources. This means that all the entities, business entities, have to accept the standard that they have to explore and evaluate the IFRS. This is slightly related to the first IFRS, that is first time adoption. When you're firstly adopting the IFRS accounting standards, you have to inculcate that for all your assets and liabilities, and you have to take them further in your business organization. And the seventh one is IFRS 7, financial instruments disclosure. So the financial instruments include all the financial statements, financial any bonds or contracts, anything, and these must be properly disclosed to the public to the maximum extent possible. So what if there will be a few set of things which should not be disclosed with anyone, only it should be disclosed for the particular company and the auditor. So other than those complicated things, all the rest of the things like balance sheet or the profit and loss account of any company must be must be disclosed to the public in order to get the trust. And not the trust and also it is compulsory thing for the company to make sure that it has to display its financial statements online. And the next one is operating segments. So here the IFRS 8 states that operating segments, and in this it means that all the particular classes of entities whichever is being traded or anything, these must be disclosed information. That information must be disclosed about their operating segments or products and services, anything, all the related aspects amounts must be declared, and they must be disclosed in the uh, IFRS according to this IFRS 8. And the next one is IFRS 9 financial instruments. And as we discussed, financial instrument disclosure. Similarly, the financial instruments, all the requirements like measurement, impairment, recognition, derecognition must be taken into consideration, and they must be disclosed properly. And the financial instruments must be maintained in a way which is prescribed by the IASB in the rule IFRS 9. And the 10th one is consolidated financial statements. So we will be doing the consolidated financial statements in a year, and few items will be there which cannot be dealt in the financial statements directly. So we prepare a consolidated financial statements, and uh, we will be accessing the materials through this, and we have to adopt the technique of IFRS 10 while dealing with those particular consolidated financial statements. The next one is IFRS 11 joint arrangements. So in this joint arrangement, it means that the entity must jointly control an arrangement, and it actually has to share the control and arrangements subject to joint control in as of a joint venture. It means that everything must be disclosed in the report, and it has to be, nothing must be like, no, everything must be transparent, and nothing must be evaluated. And the next one is IFRS 12, which means that disclosure of interest in other entities. In this statement, what it means, there will be a wide range of disclosures in which the entity's interests in subordinates or joint arrangements or entities must be consolidated, and these must be disclosed in a proper way. The next one is IFRS 13, that is fair value measurement. It means that uh, all the values must be taken as part of the fair value, not any historical value. The fair value or the market value, with in this fair value, whatever the present price or price of goods or any other liability, whichever is there at the present, that market value should be considered. This is called as fair value measurement. And in the 14 we have regulatory deferral accounts. So there will be there will be some deferred accounts in the management, where and these include comprehensive income, specific disclosures, statement of profit or loss. So what we have to do, we have to, when dealing with these deferral accounts, we have to follow the rules and regulations which are related to this regulatory different deferral accounts, and we have to follow the IFRS 14 rule. And the next one is revenue from contracts with customers. So whatever the revenue we are getting from the contract from the customers, we have to recognize that, and we have to evidence it, and we have to make it more informative by providing the evidence like cash memo or, any other credit bills. And we have to showcase them, and we have to disclose them. The next one is leases. So we all know leases. So when a company is getting lease, or when it is giving for lease, it means that it has, like, within a term of 12 months or less, less than 12 months, so it has to submit necessary documents for the lease, and stating that it is being leased or it is giving for lease, so specific documents must be filed accordingly. And the next one is 17 is insurance contracts. The insurance contract is nothing but, again as we discussed, it is nothing but getting the reinsurance and getting the reinsurance for the entity's financial position and financial performance, for the cash flows and for the cash inflows and outflows. Everything must be reinsured, so that for any future uncertainties, the company will be having a backup or an asset. So yes, these are the various IFRS accounting standards which are issued by the IASB. Thank you for watching the video till the end. uh, Please like my video and share the video. Thank you for watching. Bye bye.